Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, Eitel.
All right. Hey, guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. And, guys, we have an awesome show lined up for you this week. We are going to touch on something that I think is super, super cool. Can you buy a property today with a sub 3% interest rate without having to buy the rate down? Yes, guys, you can. And we're going to tell you about a platform that makes it so much easier to find those properties. Hey, but before we get to that, you are in the right place. If you've got questions, if you're frustrated, curious, if you're scratching your head wondering what's going on with real estate and mortgages in this crazy environment that we're in, sit tight. This is the show for you. Each week we dive past the headlines and bring you the data, the tips, the tricks, the strategies, and all the info that you need so you can go out and make better real estate and mortgage decisions for you and your family. And guys, if you have questions or comments along the way, please call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen, my producer, is womanning the hotline, and she will get your questions on the air. If you prefer to shoot us an email, just head over to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. And I'm not sure that if it's up yet, but pretty soon, if not today, maybe tomorrow or the next day, tech department, please jump on this. We're going to add a bar right under the show tab. You'll see questions and comments. If you click on that, you'll be able to fill it out right there online. You won't even have to send us an email. But just in case, if that button's not up, head to the bottom of the page and click that email icon, and you can shoot your questions to Jen that way. All right, guys, without further ado, I want to dive in because I found something that was super, super interesting this week. You hear me all the time talking about there's opportunity in every market, right? We say it all the time. Look at the opportunities, not the obstacles. I kind of preach that to my team, and that's how we operate our business every day. We're trying to find the opportunities in the market. And yes, there are opportunities even at these interest rates and at these prices. There's opportunity out there every day for people to make their dreams come true. We're seeing people capitalize on their equity and pay off debt, capitalize on their equity and buy additional properties. Parents and grandparents are tapping some of that equity and helping their kids and grandkids buy properties. Guys, we're seeing all of these strategies play out, and a lot of people are still winning, even though the headlines indicate that the world of real estate and mortgage has come to an end. Not at all the case, guys. And I want to share something super cool with you. So you hear me all the time talk about how I'm very excited about using an interest rate buy down strategy. And we talked a little bit about it last week because a lower interest rate can reduce the monthly payment far, far more than just lowering the prices. We talk a lot about that, and we use permanent buy down strategies as well as some of the 3-2 and 2-1 temporary interest rate buy down strategies to make that happen. Well, it's no secret that the vast majority of mortgages in this country are sub 6% with a big, big chunk that are lower than 5%, 4%, and even 3%, if you can believe that. So if you're a buyer out there and you can find a property with an assumable mortgage and make that assumption, you can buy a property with a 2.875 with a 3% interest rate and easily pay the higher sales price without feeling the pain of that higher mortgage payment. And here's a couple of examples I want to share with you. I found some properties. These are in Georgia. One is a list price of $305,000, so well below the national average. And to assume the mortgage, it's going to require $51,000 out of pocket. But you're assuming a 2.875% mortgage. So you've got a mortgage payment of $998 on that property. Man, that's less than half of rent. Oh, guys, and that's a 4-bedroom, 2-bath property with a yard. That's a single-family home. That's a pretty house, by the way. If you were to buy that with a 7.5% interest and use that same math, you'd be at an $1,802 payment. So darn near double you're saving a big chunk by assuming that 2.875%. Now, if you're selling a house and going out there and buying it, you probably can make a bigger down payment because you've never had this much equity. We talked about it last week. The average U.S. household has almost $200,000 in equity. So when you talk about assumable mortgages, most people's minds go to, I've got to make a giant down payment to bridge that gap, which you do in some instances, but not in all instances. Here's another one in Georgia, a 4-bedroom, 3-bath. This is a beautiful home, 2-story, very, very cool architecture. It's on the market for $840,000 with a 3% assumable mortgage. So $75,000 down in this example, has a mortgage payment of $2,957. Guys, that's for an $840,000 purchase at 3% interest, a $2,900 mortgage payment. If you were to buy that property with today's interest rates, doing that same math, you're at $5,600. So you can see the power of assuming a super low interest rate. Now, here's the challenge. How do you find those properties? And how do you find agents that are capable of negotiating those transactions? And how do you convince a seller to go through the process? Because it's not easy. It's simple, but it's not easy. That's another thing we talk a lot about. In life, there's several simple strategies, but they're not easy. An assumable mortgage is just that, because you don't come to a guy like me or my team or go to your local bank. You have to start the assumption process with the servicer. That's the company the seller is currently making their mortgage payments to start the assumption process. And then you've got to convince the seller to have a 45 or 60-day close, because this process is typically take a little bit longer. Well, guys, here's something that I found this week that I think is really, really cool, and I think it's going to catch on. There's a technology company, right? Everything's technology. Technology is going to eventually replace us, but there's a tech company that created a website and a mobile app where properties can be listed with assumable mortgages. So these are sellers who have already raised their hand and said that they are interested in selling to a buyer who wants to assume the mortgage. The cool thing is that it costs the seller no extra money, so they're not apprehensive to go through this process. And this company says they've streamlined it so that it's painless, which only time will tell, because as I mentioned, they're simple but not easy. But the cool thing is you can search. This website is dedicated just to sellers who are willing to let you assume their mortgage. And it shows the interest rate, it shows the payment, and it shows the amount of money that you'll have to bring to bridge the gap. So truly, truly fascinating. And I do believe this is going to catch on in a big way. Guys, I'm going to be talking more and more about this. If you want information about it, go to MrMortgageRadio.com and click on that Facebook page. I'll share the link to the website and to the app. It's called Roam. We'll share some direct links so you can get there and check it out for yourself. Right now, it's live only in Georgia, and I think they've got about 8 or 10 states that are waitlisted. So they're going to roll this out nationwide. But it might be an easy way for a home buyer or a home seller, if you've got a low interest rate and you want to go this route, but certainly a home buyer, to find the very best opportunities in their market when it comes to assuming a super, super low interest rate. But guys, I wanted to share that with you. Hey, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. Guys, if you have questions or comments, just call or text 855-462-7292. That is 855-462-7292. That is the Anytime Hotline, and Jen is womanning the hotline. She'll get your questions on the air for you, or if you prefer, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over to Jen via email. And hey, during that last break, a couple of people text in, what was the name of that app? Guys, it's called Roam. I am going to pin it to the top of the Facebook group. Just go to MrMortgageRadio.com and click that Facebook link. It'll take you to the page, and on top of the page, I'll pin the link to that app because I think it's going to be game-changing. It's going to be a super easy way to search properties that have assumable mortgages with sellers willing to go through the process. So I think it is a great place to find opportunities in this market. So, hey, Jen, go ahead and throw me a question.
Natalie sent this. I'm getting married in a few months. My dad wants us to ask for money for a down payment instead of setting up a gift registry. Will this work from the bank standpoint? Excellent question, Natalie.
That is an excellent question. And yay, Dad. Great idea, Dad. Kudos to you for suggesting that. Natalie, this will work. And we talked about technology changing the way we find assumable mortgages for sale on properties, or properties for sale with assumable mortgages. This is another place technology has made this strategy so much easier. There are several wedding registry apps out there that will allow you to receive gifts for things like a down payment or your honeymoon. And the cool thing is, by using one of the apps, it's far easier to document the gift funds, if you will. And that in the past has been what the challenge is when you're using these smaller denominations from a larger group of people as far as gifts are concerned. So brilliant question. And I think you're going to see more and more people, if anything comes out of this, COVID era, van life, minimalism, tiny house type living, people have realized that they don't need a blender or another bread maker or an extra set of dishes to be happy in life. What a great way to get started. What if Dad doesn't even spend, and maybe Natalie, you don't want to hear this, but what if Dad doesn't even spend a ton of money on the wedding and starts the ball rolling for you with a gift toward a down payment, and then instead of the registry, you take the gift funds to top the down payment off, and you and your husband are up and running with that first home. So brilliant idea. I love it. And yes, you can do it. If you need help with what app makes it easy, there's a few of them. I know my team's got some experience with which apps make it easier. Just shoot us an email and I'll send you back the recommended apps for streamlining the documentation side of that. But yes, you can do it. So go ahead, make your plans to incorporate that as part of your registry. Brilliant idea. Thanks for that one. Hey, Jen, go ahead with another question.
Eric sent this email. I'll try to keep this short. I'm using a VA loan, buying a house for $320K, and the seller is paying 3% towards my closing costs. My mortgage guy is now telling me I need to pay off a couple collections before I can close. I'm down to the last dollar on this one. Any advice?
Wow. Okay, I need to know a lot more to give you really sound advice, but let me just kind of broad stroke this where my mind goes immediately. Depending on the amount of the collections, you might be able to ask for a slightly larger contribution from the seller because 3% is not maxing out the VA guidelines. So if the seller is willing to pay a little bit more of a concession, if you will, or a seller contribution, you can use those funds to pay off the collections. If the house appraises for more than the, $320, then you can increase the sales price and they can give you back that difference as long as it doesn't exceed the maximum allowable percentages for a VA transaction. So you might have a little bit of wiggle room in the math, depending on the seller's willingness to up their contribution if you are truly every nickel in on this. So I welcome the opportunity to have a conversation with you off the air and see if we can't maybe deep dive this one, because that's not enough info. But the encouraging thing is there are some opportunities within the seller contribution guidelines as far as what those monies can be allocated toward. And if the seller's contribution will cover, or the increased seller's contribution will cover the collections or the charge-offs or whatever they are that you have to pay, that might be a workaround. I would need to know a lot more info before I could give you a great answer on that. And I'm happy to have that conversation with you. Maybe we can come up with a strategy that you can take back to your mortgage guy and make it work. But I appreciate that question. Hey, Jen, can we squeeze in another question?
Max is asking, I run a cash business and show very little income on my tax returns. Can I use a bank statement loan? How does that work? Thanks.
Hey, Max, that's a great question, my man. Yeah, that's where I would go, bank statement loan. And the way that particular loan program works is a percentage of your monthly deposits is what's used as your income in the underwriting process. So depending on what type of business you have, because not all of them have the same percentages of deposits applied towards income. So as an example, if you were a consultant and you didn't have to buy a bunch of materials or have a bunch of expenses, maybe you worked from home, the majority of your income is truly income. But if you're a handyman or a painting contractor, you've got to buy materials, you've got equipment that you've got to own and maintain. A smaller amount of every dollar that you deposit is truly income. So there is a percentage applied to your deposits. And depending on the program, it's either an average of the most recent 12 or 24 months worth of bank statements. The 24-month program is preferred. And then that percentage is applied to those deposits to determine an income. And then the rest is pretty much the same. I hope that helps. That's a great question. And that's a big one. A lot of people don't realize that that program even exists, and they think that they're just stuck with no options. But there are options for just about everybody out there, assuming that you can afford the payment. So anyway, guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, if you have questions or comments, Jen is back there womaning the Anytime hotline. The number is 855-462-7292. You can call or text that number, 855-462-7292, 855-462-7292, or head over to MrMortgageRadio.com, scroll to the bottom of the page, click that email icon, and you can shoot your questions over to us via email. That's MrMortgageRadio.com. And man, we've had some good questions so far. Let's keep the questions coming. Hey, Jen, do you have another one back there?
Sandra has this question. If my mom takes a reverse mortgage, what happens to her home when she dies? Does it automatically go to the bank?
Hey, Sandra, that's a great question. No, it's going to be just like if she had a normal mortgage. So if it passes to you or it goes into the estate or whatever her end of life plan is for the property to change hands, it's going to do so with that lien. So if it goes into probate, you'll have the opportunity to either sell or refinance the property to pay off that mortgage, and then whatever the proceeds are will be distributed according to her wishes. So just because there's a reverse mortgage on it doesn't mean it automatically goes back to the bank. You have the opportunity, just as you would if there was a forward or normal mortgage on the property. It's just a recorded lien that has to be satisfied. Now, here's one thing that's super interesting about the reverse mortgage. Let's say she lives a long and healthy life after she takes out the reverse mortgage, and let's say property values go down. And this actually happened in the 2008 to 10 cycle of the crash. She owes more than the property's worth. Well, the good news for you and anybody else in the will is that it's non-recourse at that point. It's a federally insured loan program, so the loss is insured. So if she dies and the property is upside down, none of that negative equity will pass to you, and you won't have to liquidate other positions in the estate to satisfy it. It's satisfied by an insurance policy that's built into part of the loan program. So I hope that helps, but that's a big one we get oftentimes. The reverse mortgage is super, super misunderstood. If anybody out there has questions and you want to start the process and just get some information, not ready to talk to anybody yet, just go to MrMortgageRadio.com and click on that More About Reverse button. You can request your booklet there. There's a little explainer video. We'll give you any information we can to answer questions and help you get an understanding of how the program works. But great question. I appreciate that one, and I hope that helps. Good luck with that, and if you need us, we're here and happy to help. Hey, Jen, throw me another question.
Here's a text from Brian. Cash out refinance versus debt consolidation refinance. What's the difference?
Hey, Brian. I get it, right? It feels like the same thing. I'm refinancing my house and pulling out some equity. With the debt consolidation refi, we can actually pay the debts off at closing. So we can reduce your debt to income ratio by whatever debts are being paid off. So oftentimes it makes it easier to qualify for the cash out refinance because we're reducing your debt to income ratio by paying off things like your credit cards or car payment or boat payments or whatever it is. With the cash out refi, you're just refinancing the house, taking a lump sum of cash at closing, and now you're adding that new payment to your debt load. So as long as you can meet those guideline requirements as far as the amount of debt to the amount of income, then there's not a ton of difference. But the big difference is how the debt to income is calculated with the debt consolidation refinance. So one is using the equity that you're taking out to pay the debt off right there and then. The other is just taking out some equity to do something with outside of the closing, if you will. So I hope that answers your question. And the other refinance option is rate and term, which we're not going to see for a while. And that's when you're simply lowering the interest rate or shortening the term of the loan. And that refinance program has a slightly better interest rate because the risk associated is less to the lender. So I hope that answers the question. If you need more info, you know how to get hold of us. So, hey, Jen, toss me another question.
Matt is asking, can I buy a fixer-upper as a first-time buyer and finance the renovations?
Hey, Matt, that's a great question. Yes, there are a variety of loan programs that allow you to buy a property and finance a portion of the renovation costs. If it's going to be your primary residence, there's an entirely different set of loans than if your intent is to fix it up and sell it in a short period of time, then that's a fix and flip loan. But the good news is either way, there are loan programs that'll allow you to buy a property and then roll a portion of those renovation costs into the loan. As I mentioned, FHA, VA, USDA, all of the primary resident loan types have programs for that. as well as some of the investor loan strategies with the fix and flip loan product. So great question. And as always, if you need more info, please don't hesitate. Reach out. We're here and happy to help. Hey, Jen, throw me another question.
Sylvia sent us a question. If we take a reverse mortgage, can we move and keep this house a rental? We'd like to be closer to our kids in about 10 years.
Hey, Sylvia, that is a great question with a very, very easy answer. No, you cannot do that. The reverse mortgage has to be on your owner-occupied primary residence only. So as soon as you move out and turn your property into the rental, you're going to negate that primary residence owner-occupied status. And at that point, you would want to either sell the property or refinance it as an investment property. And that strategy may work. You mentioned 10 years, so you'll want to do the math to make sure you preserve your equity position to the point that you can absorb both the costs of the reverse mortgage and then in a 10-year time period, the refinance costs. But if that works, that might be a strategy that allows you to convert it to an investment property then, and it still makes sense. So brilliant question, but no, the reverse has to be on your primary. Can't be on a rental. Now, with that being said, you can buy a 2-unit or a 3-unit or 4-unit property, technically an income producing property, and use a reverse mortgage to buy it and then have no monthly mortgage payment and the positive cash flow from the property. So there are strategies to create income from a reverse mortgage, but it's just not as simple as doing it and then renting that property out, because you'll be required to either refinance it or the note may be called due. So just wanted to share that. Another thing we're seeing people do is take the reverse mortgage, pull some equity out of the property, and then buy an investment property or use the equity to gift monies to their kids or grandkids to help them buy real estate. So we are seeing more and more interest in the reverse mortgage in and of itself, and then a lot of creative uses of the equity of late. So brilliant question. I appreciate that one. If anybody out there wants more info about reverse mortgages, just check out MrMortgageRadio.com. There's a big tab there that says more about reverse. But guys, you hear the music? You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, if you have questions or comments, just call or text 855-462-7292. That is 855-462-7292. That is the Anytime hotline. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. On the bottom of the page, you'll see a little email icon. If you click on that icon, you can shoot us over an email. We will get your questions on the air, or if we're not on the air, we'll definitely shoot you back an answer. So let's throw it over to Jen and keep your questions coming. Go ahead, Jen.
Sam sent us an email. I've been hearing a lot about assuming a low interest rate when buying a house. How exactly does this work?
Hey, Sam, that's what we were talking about in the opening segment, my man, in that new app and website that features only properties for sale with assumable mortgages. So great question. The way it works is you're going to call the servicer of the seller's mortgage. That's the company the seller is currently making the mortgage payments to, and ask for the assumption department, because that's who facilitates the assumption. It doesn't go through a new lender, not even us here at the Mr. Mortgage team. We can help you and answer any questions you have, but it's actually facilitated by the servicer's assumption department. So I hope that answers your question, Sam. That's a great one. Hey, Jen, throw me another question.
Here's one from Kobe. I'm a first-time buyer. My folks are willing to help however they can. If they co-sign for me, can I still use a down payment grant? They already own a house and are not first-time buyers. Thanks. You guys are awesome.
Thanks, Kobe. And in most cases, yes. Even though your folks are co-signers, right? They're technically non-occupying co-borrowers. Almost always the down payment, I was going to say DPA, the DPA program, down payment assistance program, will work within the traditional FHA guidelines, which allow the cosigner or the non-occupying co-borrower. So you should be okay with that one. If you run into a problem and you need some help, just reach out. But just know in the beginning, moving forward, that should work even though they currently already own a property, because they are going to be classed as non-occupying co-borrowers. But great question. Hey, Jen, do you have another?
Cecilia sent us an email. How does selling and giving the equity to my son work? I'm happy to let him take over the house, but I do need a little money out of it for my next place.
Hey, Cecilia, great question. You will be selling the property and giving a set dollar amount of equity. So let's say you have a property that's worth $300,000 and you owe $100,000. You have $200,000 in equity. You could sell it to your son for $300,000, gift him $60,000 in equity so that he is now at an 80% loan, and then the balance of the equity could be what you take with you for your new place, or any mathematical equation of that makes sense to you. So it's not like he's taking over your mortgage. You're actually selling him the property, and instead of him needing to put a down payment down and closing costs, you're just gifting him that amount of money out of the equity, and then the rest of the equity would go to you. So I hope that makes sense. We see that often. We do a lot of transactions like that, and you can get super creative with how you use that equity to make the transaction work really well for both parties. So congratulations on being in the position to help him get into the home with that equity strategy. So great job. If you need more information, you know how to reach us. I'll do whatever I can to help, but I appreciate that one. Go ahead, Jen.
Lee sent this. Can I use the landlord loan for a cash out refinance? Is the income still based on the rents only? I'd like to start using that BRRRR strategy you talk about.
Hey, I was going to suggest that. I'm glad you must have caught that on the podcast. So guys, BRRRR, B-R-R-R-R, buy, rehab, rent, refinance, and repeat is what the acronym stands for. You'll hear people just call it BRRRR. It's buy, fix the property up, get the property rented, refinance it, and then go out there and buy another property. So yes, you can. You can use the landlord loan as a cash out refinance, and it works exactly the same way. We're just looking at the income that the property produces. So we're not looking at your personal income. So whatever rental income is currently on the property, that's going to be the income used in that debt to income ratio, and just the debts of the property. So hope that helps. But yes, sir, a lot of people use the landlord loan and that BRRRR strategy to parlay it into a nice real estate portfolio. Great question and great strategy. Hey, Jen, toss me another question.
Here's an email from David. Why do I hear agents saying FHA loans are a bad choice? The rates seem better. What am I missing?
You are not missing anything. It's the agents that are missing it. So I don't know the answer to that question. Somewhere historically, somebody started a rumor that VA and FHA loans are difficult to close and put the seller at risk. Well, that's not the case, guys. As long as the property's not in disrepair, there's very, very little difference from the mortgage standpoint as far as the seller's concerned. Now, that being said, if there's broken windows or chipping paint or exposed wires or staircases with no handrails, both the VA and FHA loan will call those out as necessary repairs. But in and of itself, the FHA and VA loans are amazing loan programs. And right now, as you mentioned, you're seeing they carry a lower interest rate. So why would you not want to consider that FHA loan? It's a brilliant, brilliant loan program. And it's just a wives' tale. We do not have a difficult time getting FHA loans closed. Outside of those property conditions that I mentioned, it's really just a confusion that turned into a myth that has spread like wildfire, primarily through COVID. So I'm happy to talk to your agent for you, but a rock solid FHA approval should not be anything that you're afraid of if you're a seller. So brilliant question, though. I appreciate it. And I take that one personally because I have a big place in my heart for first-time buyers, and a lot of first-time buyers utilize that FHA program. So I would be happy to dive in if you need some help with that. But great question. Hey, Jen, let's try to squeeze in another question.
Here's one from Sandra. We're selling, and I was going to use my current mortgage company for the new house, but the fees seem high. They even want to charge me a fee to pay my taxes and insurance myself instead of paying it each month. Is this normal?
Hey, Sandra, that's a great, great question, and thank you for asking that one. I can't speak to all of the fees without seeing the fee sheet, and I'm happy to review that fee sheet for you if you like. Guys, we have a free service for all of our listeners called feesheetreview.com. There's no obligation. If you're in this situation, like Sandra, and you've gotten a mortgage quote and you're not quite sure if it all makes sense, just check out feesheetreview.com. We'll look it over and we'll tell you one of three things. Either, hey, this is an awesome deal, march forward knowing you did great, and then you can focus on the move. Or we'll point out some places in there that you can renegotiate with your current lender, or we might even be able to offer you a better deal altogether and save you a bunch of money in either fees or interest rate. Now, let me dive into the escrow waiver portion of it. So it's not uncommon, Sandra. A lot of lenders will charge an escrow waiver fee. Now, luckily, we have programs with no escrow waiver fee, but that's not the case with everybody. And the reason a lot of lenders charge that fee is because it puts them at a higher risk if they are not holding the taxes and insurance and escrow. And that's because the only thing that supersedes a first mortgage in a foreclosure auction are the taxes and any municipal liens, but the municipal liens are often few and far in between, but the taxes are a big, big thing. So the lender wants to make sure the taxes are paid on time, because each time they're not paid, that's extending risk to the lender, who now suddenly is in second position behind the taxes. And then the insurance is the obvious one. You know, God forbid there's a fire that burns the place to the ground, or there's a hurricane that blows the house away, then the collateral has been diminished greatly and the lender is placed at risk. So an escrow waiver fee is not uncommon. A lot of people charge it, but just know that several lenders do not have the escrow waiver fee. So certainly ask how you can avoid that without having to pay the fee or have the rate adjusted accordingly. I'm happy to jump in if you need help. As I mentioned, we've got programs with no escrow waiver fee, but at very least, I would love to get my eyes on that fee sheet and see if we can't point out some places that you may be able to save some money. So great question. I appreciate that one. Hey guys, you hear the music? You know what that means? That's my cue. No, it's not my cue. It's my cue to stop talking. We're wrapping up another week right here at the Mr. Mortgage Show. Man, time flies when you get me in the studio with Jen and your questions. I love doing the show for you each week, guys. If you need us during the week, just check out MrMortgageRadio.com. That's MrMortgageRadio.com. Otherwise, we'll be back next week right here, same time, same station. All right, guys, have an awesome week. We'll see you next time. Be good.